This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping. In this video, I want to focus on the importance of going for a reward that is at least twice as big as your risk when you're swing trading. For example, here's that British pound versus the dollar 5-minute chart, and you have a breakout bar here and a follow-through bar here. It's reasonable to buy that close. If your stop is 1 pip below the bottom of the breakout, you're risking 29 pips. If a reward is 60 pips or more, in other words, twice the risk, the trade is a swing trade. If you're going for a reward that is less than 60 pips, you can call it a scalp. Stop 1 pip below, and you bought that close. This is 1 times your risk. If you exit here, it's a scalp. Here's 2 times your risk. If you exit here, it's still a scalp. You did not allow a pullback. You exited on the first pullback, and you're going for a reward that is less than twice your risk. On the other hand, if you exited up here, possible parabolic wedge, 1, 2, 3, or 1, 2, 3, and you have a bear bar closing on its low after a small buy climax, you would be exiting with 80 pips profit. Your initial risk was 29 pips. 2 times your initial risk is 58 pips, and this is more than 58 pips, more than 2 times your risk. To me, that's a swing trade. Plus, you exited with 2 legs up, 1 pullback 2. And you held on for more than 10 bars. You held on for about 20 bars. Most swing traders hope to get trades that last 20 or more bars, but their minimum goal is 10 bars and 2 legs. This is a 60-minute chart of the British pound versus the dollar. In general, on a 60-minute chart, if you're going for a trade that's less than 50 pips, I call it a scalp. On a 5 or 15-minute chart, I call a scalp anything that is between 10 and 40 pips. Anything more than that is a swing trade or simply a trade. Again, the swing trade has at least 10 bars and 2 legs. Usually, a trader is going for at least 20 bars. Here we have 3 very big bear trend bars, and you can call it a wedge 1, 2, 3 at the top of a broad bull channel. You can also call it a wedge 1, 2, 3 or 1, 2, 3. In any case, strong reversal down, and we're closing below a lot of bars. This is probably the start of a swing trade down. 3 consecutive big bear bars closing near their lows, strong bear breakout, good context. The odds are high that you're going to get at least a measured move down. High odds mean at least 60% chance that you'll get a measured move down. It's reasonable to sell that close, putting a stop above the top of the bear leg or above the top of this 3-bar sell climax, and you take profits down here. This is 90 pips below your entry price, and therefore it's a swing trade, or you could simply call it a trade. Also, it lasted more than 10 bars, and it had at least 2 legs, 1 pullback 2. Scalpers hate pullbacks. Sometimes they'll hold through what they think will be a minor pullback, but in general, they don't want reversals. They don't want pullbacks. Let's say you buy here, around a 50% pullback of this buy climax, this breakout, 2 legs down, 1 pullback 2. You can also call it a wedge. There's a bear bar, a doji bar, a big bear, a doji bar, and then another low here. Let's say the trader bought above the high of this bar, hoping for a wedge reversal up, and he put a stop just below. Very small risk, but you can call it a high 2 bull flag, a wedge bull flag. Whenever you're trading with a very small risk, you in general have a low probability of success. I think it's reasonable to take this buy for a scalp. The risk is very small. If you did buy above this bar, you got filled here, stop down here. You have dojis here, tight trading range. Maybe you'll allow the pullback, hoping for a little bit more up. Most bulls who did buy above this bar or above this bar will not exit. They'll probably either rely on a stop here or possibly a stop down here. The market got up and tested a prior lower high and reversed down below there. At this point, a lot of bulls will exit either below that bear bar or a second entry short below that bear bar because they'd be concerned about a double top lower high and a reversal down. The bulls who buy here, who did not exit here, now have a second reversal down, so low 1, low 2, and a bear bar. A lot of those bulls will exit here for a scalp. Another example, bear bar, bull bar, bear bar, bull bar. So 2 legs down, 1, 2. If you want, you can call it a high 2 bull flag, high 1, high 2, or 1 push down, 2 pushes down, high 2. You can even call it a wedge. 1 pullback, 2 pullback, 3. Doesn't matter. It's a tight trading range after a strong bull breakout. It's a reasonable buy. You have a good buy signal bar. You can buy above that high for a scalp, put a stop just below. You have a small pullback, but you're still in a tight trading range, and it did not hit your stop. Most bulls would hold long and rely on their stop. Maybe they hold long after this breakout, despite this pullback. A lot would exit below this second reversal down, but many would hold and get out up here. A big bull bar, a buy climax. And if you're looking for a quick profit, you're getting a gift, a big bull bar closing on its high and a new high. We have a strong bull breakout, and then a second leg, and then a third biclimax. So biclimax, 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 with 3 highs, possible parabolic wedge top, and you have a bear bar closing on its low. Some swing traders will take this short, others will wait until there's a strong bear breakout and then short, but it's reasonable to sell below that bear bar, and you get filled right here, and you put a stop above its high, a parabolic wedge top. Strong bear breakout with 2 bars. The second bar is the follow-through bar, confirming the bear breakout. The odds are now high that there'll be a second leg down. Traders will keep their stop above here. This is a major high that led to a strong bear reversal. Chances are, even if we rally like this, a couple legs up with decent bull bars, the market will get at least a small second leg sideways to down before it hits that stop. This pullback went above your entry price. Remember, you sold here, and the pullback went above your entry price, but it did not hit your stop. Most bears would continue to hold short. However, if you did sell here and you held short even though the market went above your entry price, and then you got another strong leg down, bears do not want the market to come back to their entry price a second time. Many bears would then move their stop to break even, or they'd simply put their stop above the top of this strong bear breakout because this is a major lower high. Traders do not want the market to come back to their entry price a second time after there's a second strong leg down. First leg down, second leg down. And you can see this reversal up did not get back to the entry price a second time. After the second leg down, traders either put their stop above the top of the bear leg, above the top of the sell climax, or even break even. Remember, a bear trend needs lower lows and lower highs. Lower highs are more important because bears exit if the market goes above a major lower high. If it goes above a major lower high, then they think the bear trend has ended and the market has either evolved into a trading range or possibly even reversed into a bull trend. Strong reversal up, high 2, bull flag, bull trend, first leg down, pullback, second leg down. So this is a high 2 bull flag, strong reversal up. Swing traders will hold short. A lot of them will hold short, relying on their stop, hoping that this is a broad bear channel that continues down much further. Strong bull breakout, but bad follow through. Strong bull breakout, bad follow through. This might be a broad bear channel. Usually, even though it's 3 pushes down, 1, 2, 3, and therefore a wedge bull flag, bull trend, wedge bull flag, with the bad follow through, we're probably going to get a trading range before an attempt at a bull trend resumption. 2 decent bull bars, bull bar closing on its high. It's reasonable to buy this for a possible swing up. We have a bull trend, a wedge bull flag, a bear channel, bull flag, and the sell-off is not all that strong. We have a pair of bear bars, but 5 or 6 bars up with a lot of bull bars. A bear bar and a follow-through bar, another bull bar. A pair of bear bars, dojis, and a big bull bar. This looks like it'll be a bear leg in a trading range, or a bear leg that becomes a bull flag. Now we have a strong bear breakout that looks like it's failing. It went above this bull bar, and then we have a second entry buy. This is a reasonable buy for a wedge bull flag and possibly a swing up. Different ways to draw the wedge, 1, 2, 3, or 1, 2, 3. A little bit more than a 50% pullback. For the bulls who did buy here and who decided to hold for a swing, looking for a second leg up, leg 1, pullback, leg 2, some of them would hold and put a stop below the bottom of the bull trend, and they'd view this strong sell-off as simply a breakout test of the buy signal bar. Also a micro double bottom and a strong buy signal bar. If the bulls did buy here for a swing, this reversal down fell below their entry price. However, if there's a second strong breakout, the bulls do not want it to come back to their entry price a second time. Some bulls would exit on a second reversal down, leg 1, leg 2, betting that maybe we'll be in a trading range instead of a bull trend. Remember, this bear channel might be evolving into a trading range. It's big up, big down, big confusion, and chances are the market's going to go sideways. Trading ranges often have 2-legged moves, 1 pullback 2. It's reasonable for the bulls who bought here to exit below here, thinking that it might be simply 2 legs up in a trading range and the end of the rally. If a trader did not exit here, he probably would exit back at his entry price because we have a strong trend resumption up. He does not want the market to come back to his entry price a second time. This turned out to be a minor lower low, just a little bit below there. But you do not want the market to come back to your entry price a second time after it resumed up. If you do get stopped out, it's perfectly reasonable to buy again. Now we have a double bottom bull flag with a decent buy signal bar. However, most traders should get out when it hits the entry price a second time after the bull trend resumed. Again, if it comes back to your entry price a second time, the odds are you're going to be in a trading range and not a bull trend. And in a trading range, you want to be scalping, not swing trading. Reasonable to get out here on the break below this low and the test of the original entry price. But if you did exit, as I said, it's reasonable to buy again above a good bull bar because now you have a double bottom higher low and possibly you'll get a breakout above the neckline and rally for a measured move up. So double bottom this low, and neckline here. The market sold off again, 3 legs down, 1, 2, 3. Does not matter that the market went to a new high after that first leg down. That's common when you have a bull trend transitioning either into a bear trend or a trading range. There's a transition period when the market is both in a bull trend, in other words, you can keep going higher, and in an early bear trend. So the bear trend often begins before the bull trend ends. 3 pushes down, 1, 2, 3. We have a micro double bottom. We tried to go up here, we went down, tried to go up again, and we have a bigger double bottom with this low. This is a support area. They bought here again. We're testing that price again. It's reasonable to take this buy. The buy signal bar is a doji bar, so it's not as strong as it could be, but it's still a potential wedge bull flag and a double bottom bull flag. Bear trend, bull breakout, double bottom, higher low, major trend reversal. You can also call it bull trend, bear reversal to a big double bottom, higher low, major trend reversal. You could also call it a big double bottom bull flag. You have a bull trend and then a pullback into a big double bottom, so it's a big high to buy. On a higher time frame chart, it could simply be a few bars down. On this time frame, it's 30 or 40 bars here, 30 bars here. Now we have 3 lows, 1, 2, 3, in a horizontal pattern, a trading range. It's also a triangle, and traders would buy this as a reversal up from the bottom of a triangle. Different computers see patterns differently. If there are many different patterns, all with the same entry price, there's a higher probability that you'll have a profitable trade. Strong bull breakout. We have 4 or 5 consecutive bull bars, 2 of them big bull bars closing on their highs. Strong breakout of a bear channel. A bear channel is a bull flag, and we have a strong breakout. The market came back below the entry price. It's a breakout test, a test of the top of the buy signal bar, but it did not hit the stop. So traders are still holding long. Strong enough breakout. This is probably now a major higher low. Traders do not want the market to fall below this low. Also, they do not want the market to come back to their entry price a second time. You can see the bears tried to get it here, and it tried to get down to the entry price here. Both times failed. Many bulls after this rally would move their stop to break even because if the trend is good, it should not come back to that entry price a second time. The bears tried to get a double top bear flag, tried to get a strong reversal down. And as strong as the reversal down was, it failed to hit the entry price. And you can see the bears giving up on this bar and the bulls becoming confident that we'd go up for at least a measured move. We have a double top and a neckline. Instead of breaking below the neckline and falling for a measured move down, we're breaking above the top. Traders expect at least a measured move up from the neckline to the double top and then up here. Small trend bar. Every trend bar is a breakout. Every trend bar is a climax. And here is a series of trend bars, a sell climax, climax, sell climax, sell climax, small sell climax, sell climax. You have consecutive sell climaxes, but on a higher time frame chart, for example, if this is a 5-minute chart, this is the 240-minute chart, here's that sell-off, here's the sell-off. It's simply a test of the bottom of a trading range. At this price level, the market reversed up here. It came down to the price level again, reversed up. It came down to that general area, reversed up. And this could simply be a sell vacuum test of support where the bulls bought 3 times before. 1, 2, 3. On the 5-minute chart, this looks like a very strong bear trend. But it's consecutive sell climaxes, which usually result in a trading range or a reversal. And it's also at the bottom of a big trading range on a higher time frame chart. And if you want, you can call it a micro wedge, 3 pushes down, 1, pull back, 2, pull back, 3, and a larger wedge, 1, 2, and then 3. Second entry buy, first entry, second entry. It's a reasonable, aggressive buy for bulls looking for a swing up. If they buy above this bull bar, reasonable to put a stop below the low of this bear bar, betting that the support at the bottom of the 240-minute trading range will hold. A very tight bear channel, first reversal up minor, which usually means you'll enter a trading range either here or here. Higher probability to buy above this bull bar. We have a reversal up and now a higher low, probably going up for a second leg, and probably we'll get to the top of the most recent big sell climax, this high. Strong enough up here or here, the market's probably always in long. It still could be a lower high and a bear trend, but at this point, probably always in long. It's a complex rally. We have a pullback, we have a pullback, we have a pullback, and a pretty tight channel. Probably it's the first of two larger legs up. So leg one, a complex pullback, and then leg two. Scalpers are going to be pretty quick to take profits. For example, we have two legs up, one pullback two. A scalper would get out here or here. Three pushes up a wedge, 1, 2, 3, testing near the top of the sell climax. Scalpers would exit below that bear bar or below this bear bar and get filled here. That's because the probability of higher prices has fallen at this point. High probability here or here that we're going at least a little higher. But once we get the reversal down here or here, the probability is that we're probably going to go sideways. We might even reverse, but the probability has dropped, and therefore the premise of a scalp is no longer valid. A pair of strong bear bars, but possibly a higher low and possibly a 50% pullback. New bull trend, 50% pullback. The premise for swing traders looking for a second leg up is still valid, and swing traders would hold long, even though we have a pair of consecutive bear bars. It's a breakout test of this high, and it's about a 50% pullback, and both bear bars have tails below, so they're not especially big. This body is smaller than that body, so the reversal down is losing momentum. In this video, I defined a swing trade as a trade where you're trying for a reward that is at least twice as big as your risk. The probability for a swing trade in general is at least 40%, and if you have a reward that is twice your risk as your goal, you have a positive trader's equation. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping.